Real estate investing has always been sold as the easiest way to get rich, earn passive income, and retire early, and millions of people have gotten wealthy with this playbook in the past, but it's outdated given our current economic environment. So in this video, I'm going to break down why Bitcoin is a much better investment than real estate. Let me start by just explaining why real estate became so popular in the first place. It only took me a few months working at a corporate job at a college to start looking for a way out. And like a lot of other people online, I found real estate as what seemed like the easiest way out for me. You got cash flow, passive income, and then a tenant that would live in the house and help you pay down the mortgage at the same time. But when I started looking at real estate's returns, the real estate market averaged around 5% per year, while I could get 10% just sitting in the stock market. So it didn't make a whole lot of sense to me. Why would I sacrifice 5% of returns for what seemed like a lot more work? And this is where two of real estate's biggest strengths come in. The core of this playbook starts with leverage and debt. And leverage is the idea that you can use the money that you have now, take it to a lender, and then borrow more money to then invest. And you can think about leverage like a power tool. It can be used to help you build and grow faster, but if you don't use it the right way, it can take your hand off. And with leverage, real estate transformed from a place that you would live in into an asset class to invest in with the creation of long-term mortgages in the 1930s. What this did was it allowed investors to put down only 5%, for example, and then get a loan for 30 years for the remaining 95%. So when the value of the house went up, it wasn't just your down payment increasing at 5%, you would benefit from the total value going up even more. For example, if you buy a $500,000 property, you'd only put $25K down. If the property goes up 20% to $600,000, you don't just make 20% on your down payment. You get the returns of the total value of the house, so the total increase is $100,000. What was a 20% increase in the value of the home is now a 400% return on your initial investment. And then on top of all this, you could find a tenant to help you pay down the mortgage over a 30-year period. And a lot of times landlords can increase rents over time with inflation. So you benefit from both the cash flow and the ability to raise rents over time, while the tenant pays down the house that you only had to put 5% down for in the first place. Then you repeat this process with multiple houses, and it became the playbook for building wealth in the 20th century. The term housing prices always go up was popularized along with real estate investing since the 1970s. And this isn't wrong. Real estate as an asset class has consistently gone up since then. But why is this? Well, there's two major tailwinds that real estate has had since the 1980s that made it the safe, predictable path to financial freedom. But these two tailwinds are starting to change, so let me break down what they are and why they're changing. The first is that the real estate market is largely influenced by interest rates, and this makes sense because the lower the rate, the lower the monthly payment, and the more people can come in and afford to buy a house with leverage. Then more demand for housing leads to higher prices. So here's what interest rates have done since the 1980s. You can see that mortgage rates fell from 18% in the 1980s to the lows in 2021 of 2.65%. A 1% drop in mortgage rates lowers the monthly payment by around 10%. So that 40-year slide pushed housing to all-time highs and made lending accessible to more and more people. But rates aren't the only thing pushing housing prices higher. Like most things that you want to buy, housing is also impacted by inflation, so more dollars in the system chasing housing leads to higher prices. And this backdrop makes the real estate strategy even more effective when you pair it with leverage. So the loan that you're getting is fixed, and then as more dollars enter the system and inflation rises, you can raise rents and increase your cash flow. And this makes the loan easier to repay as your income goes up with the value of the property. Here's a chart of the amount of dollars in the system since the 1980s. You can see a steady increase showing persistent inflation pressure over time. If we look at housing versus the growth in the money supply, real estate outpaced inflation from 1980 to the 2008 financial crisis. And that's where the chart starts to change. So since then, home prices have mostly just kept pace with the money supply expansion. This means that real returns are basically standing still. So the dollar value might be rising, but so is the cost of everything else that you want to buy. So the first pillar has broken down since the '08 financial crisis. Real estate is actually not outpacing inflation like it has in the past. And then the second pillar has also changed because rates bottomed in 2021 and they've risen since then. So as rates rise while inflation stays elevated, home prices and monthly payments both move higher, so significantly fewer people can now afford a mortgage. This softens demand and it helps explain the housing cool down that we've seen over the past couple years. But for this to really click, you need to understand why this is happening. Just imagine that you're a bank issuing mortgages. How do you decide what to charge a customer for a 30-year loan? You would need to compare it to something that you perceive as low risk and easy to purchase, like a government bond. And this is actually how mortgage rates are priced today. So banks use the 10-year government bond because it most closely mirrors how long a borrower actually keeps a mortgage. So in order for it to make sense for a bank to give you a 30-year loan, they need to be compensated for the risk that they're taking. So what they do is they add around 2% above what they could get just by buying a 10-year bond. What's changing now is this 10-year multi-decade downtrend that we've seen in the 10-year bond and mortgage rates is starting to reverse. And this has everything to do with the inflation rate of the money supply and government debt. We've seen inflation increase and stay elevated because the US government has a spending problem. They spend more than they make and then issue bonds to pay for things and print currency to cover the difference. And the buyers of government debt start to notice when the inflation rate is higher than what the interest rate is paying them on the bond. So to convince them to buy and keep buying more, rates need to come up. And as a result, we get higher mortgage rates, increasing inflation pressure, and less demand for housing. This is the opposite of the environment that we saw in the 1980s, and I think it's just getting started. So what were demand drivers from 1980 to 2021 are now problems that real estate investors really need to think through and consider. Because leverage is great when real estate housing prices are only going up, but it can be dangerous when this starts to flip. So let's talk about the risks. There's two major categories of risk when we talk about real estate. There's broad and local. Broad would be what I just talked about. So rising interest rates, softer demand, and then inflation running faster than what your home is appreciating at. So even if you have a low fixed rate mortgage, your risk is that the value of the house doesn't rise faster than inflation because the person that you're selling to in the future only now has higher rates to choose from and they can't afford the monthly payments. A lot of young people today are completely priced out of the housing market, and the solution is to build more houses and increase the supply or bring housing prices down. And with the amount of leverage that you need for real estate investing to make sense, this becomes a serious problem, as what was once working for you with housing prices going up can start to work against you. Local risks are specific to the property, so property taxes, maintenance, insurance, vacancy, natural disasters, and the location. In a high inflation environment, these costs can rise faster than the home's value, and I think you really have to factor that in. For example, we've seen home insurance premiums jump about 24% since 2021, outpacing inflation. We've also seen maintenance costs increase as much as 5.8% per year just to keep a home running. Maintenance, labor, and insurance have all been climbing since 2021, and I think we could see this trend continue. And then local policy can change basically overnight, so increased property taxes, HOA fees, and rent controls are all things you have to think about. All of these risks can significantly impact long-term performance on a home, and I think it's important that you really think through all these costs because they can be really easy to overlook at first. Most people buy investment properties not because they want to be altruistic or nice to renters, it's because they want to store value and build wealth over the long term. But now the invention of Bitcoin creates a new digital store of value that improves what real estate accomplished for previous generations without the same amount of risk. It's just a better tool for storing value and building wealth in the economic environment we find ourselves in today. So let me explain all of the reasons why. Most real estate investors like that it's physical and tangible, that they can touch it and look at it. And I get it, Bitcoin can seem really abstract at first, but the mental shift that you have to make is that Bitcoin is a better way to store value because of its digital properties. Bitcoin is scarcer than real estate because you can't build more, and demand is not directly connected to interest rates. And it benefits even more from money printing because there's an unlimited amount of dollars chasing the fixed supply. The environment we're moving into is higher interest rates and more inflation, and holding Bitcoin will allow you to benefit from this shift. Bitcoin also allows you to avoid all of the carrying costs that come with real estate. What I mean by this is even if you pay off a house, you still have maintenance, property taxes, and insurance to pay every month. Then to sell, you need to pay closing costs, and usually a realtor is about 3 to 6% of the total value. To buy and sell Bitcoin is just 1% to an exchange. And then you don't have to spend any time working with property management companies, tenants, renovations, or repairs on the house. Bitcoin is extremely liquid, and what I mean by this is I can convert it to dollars in 1 to 2 days and have those available in my bank account to spend or do whatever I want with. With real estate, selling a house can take months sometimes. And Bitcoin is divisible, so I can sell a small portion of it and keep holding the majority of my position. And you may be asking yourself, all right, with real estate, I can get a massive amount of debt and leverage, and with Bitcoin, I can't do that. But this is actually a plus because you can get higher returns without all of the debt and leverage, which is more risk. Bitcoin has averaged over 100% return since inception, but as the asset grows, returns could moderate some. So to be conservative, I'll use 24% per year for Bitcoin versus an average after expenses return of 7% for real estate on the same 25K down payment that we talked about earlier in the video. Over 30 years, that 25K in Bitcoin could grow to roughly 15 million, while the rental path lands you around 190,000 in equity. And this is without having to deal with all the headaches that come with having to run a small real estate investment business. And after realizing this, I stopped viewing real estate as my path to financial freedom, and I chose Bitcoin instead as a higher return, lower risk way to do it. So what happens when more people start waking up to this? Right now, there's about 45 million single family rental homes in the United States, and about 82% of these are owned by mom and pop investors with 10 properties or less. Most of these homes are owned by the baby boomer generation that are now approaching retirement age, and their problem is that younger generations can't afford to buy houses anymore. They're digitally native now and more prone to accepting Bitcoin as a legitimate store of value investment. Studies show that Bitcoin ownership is led by those under 50 as younger generations are now starting to see Bitcoin as their path to financial freedom, while at the same time, most small property owners are 60 or older. What this means for real estate rentals over time is that as Bitcoin adoption increases, real estate prices will become more affordable for people who save in Bitcoin. Another way to say this is that real estate prices are falling when measured in Bitcoin. So a house that cost you 24 Bitcoin just 8 years ago costs about 4 Bitcoin now. A house was supposed to be something that you lived in, a home to build a family, share experiences and memories. It was only financialized and turned into an investment when the government and banking system introduced leverage, tax incentives, and interest for profit. Then investors correctly recognize it as a tool to create wealth and avoid inflation. And this has worked well in the past, but what it did was create a premium or higher prices in houses that wouldn't exist without the additional demand from real estate investors. Bitcoin offers a better store of value and a faster path to financial freedom by improving on all of real estate's flaws. As a result, it will start to eat into this premium by replacing real estate as the best way to store value and build wealth in the 21st century. So let's talk about what this means for you. If you're young and you're still trying to buy a home, saving in Bitcoin will allow you to outpace inflation and benefit from Bitcoin adoption and Bitcoin's rise. If you're like me in the past and you're thinking about going into real estate as your path to financial freedom, I challenge you to really think through all of the costs that are involved and the trade-offs of not holding Bitcoin. And if you already own rental real estate, I'm not here to criticize you or knock you at all. You've probably done very well up until this point. But I do want to encourage you to think about Bitcoin as a legitimate replacement to keep the wealth that you have. I decided not to use real estate to leave my corporate job at first just because I didn't know where I wanted to live and I didn't want to commit to anywhere. But after finding Bitcoin, I decided it's the best way to store value and save for my future. And it's actually a faster path to financial freedom in today's world. If you like this video and you want Bitcoin-focused financial planning and personal finance tips emailed to your inbox, check out the link in the description below. My name is Austin. Thank you so much for watching, and I'll see you in the next video.